When you're first starting out doing taxes, you'll likely encounter two kinds of situations. You have basically the wage earner, maybe a married couple with a couple of kids, and it's a fairly straightforward situation. You'll be able to prepare that tax return with a good amount of ease, especially if you receive some sufficient on-the-job training, maybe from a mentor or someone in an office who's done taxes before. You can pick up those fairly easy returns and you'll be able to become quite proficient in them pretty quickly overall. Within, I'd say, a week or so, you'll be able to know the basics. And then there's the other situation where the person who's coming to you, the tax client, has more issues going on, different kinds of income, certain tax risk maybe of audit, or certain specialized situations that are more advanced. And so in this basic income tax course, we're mainly focusing on introducing you to these advanced topics. And one advanced topic that I want to alert you to with regard to California income tax is the property sale income tax withholdings for the state. So what this refers to is when someone sells a property in California, a piece of real estate, the California tax law was changed a few years ago to state that the escrow company, or any person who is in charge of handling that transaction of that sale of real estate, if it's located within California, that escrow company has to actually pay California state income tax out of the escrow. Okay, so let's say that someone sells a property for $500,000. The escrow company would be required by state income tax law, by California income tax law, to pay 3.5% of the sale amount directly to the Franchise Tax Board before giving the sale proceeds to the seller of the property. And the reason why this is important and why California made this change to the law is that what they notice is that people, when they're selling that California real estate, they're moving out of the state and they're not paying the income tax on the sale from that property. And that was becoming sort of a common way to avoid California income tax. Once someone's not living in California, it's more difficult for California to collect the tax. So what they did is they made a law where if you're selling a piece of real estate and it's not your personal residence, it's not part of a tax-free exchange, or there is going to be a gain on the property. So those are some exceptions that you wouldn't have, the escrow company wouldn't have to pay that tax to California out of escrow. But if it's a rental property, let's say, or it's some kind of income property, once the escrow company is handling that sale, that escrow company is required, in the majority of cases, to send a tax payment to the state of California directly out of escrow. And so as a tax preparer, whenever you see a property sale in California, I want you to be very aware of this tax withholding requirement. You really need to pay attention when you see a California property sale and realize, hey, was there state income tax withheld out of this sale? You definitely need to be aware, and also there's a couple tricks of how you can handle this, and that's what I'm going to tell you about right now. Whenever you see a piece of real estate that's been sold by your tax client in the past year, your ears need to perk up and say, okay, this is a situation that I need to pay attention to, and especially regarding this requirement for the escrow company to pay that California income tax out of escrow. So when your client comes in and they've sold maybe a rental property or a piece of property that was held, say they inherited, that kind of thing, the escrow company who handles the sale of that property very well may have paid that 3.5%, or excuse me, 3.33% of state tax withholdings to California. As a tax preparer, then, you need to let that client know, yes, we need to see your escrow papers, that, all those paperwork that says the seller received this much money, the loan was paid off, the real estate commission, that paper that has all the charges and all the pertinent details of that real estate transaction. And on that list, the best document is called the HUD-1, HUD-1. You use that HUD-1 statement to see, hey, was California income tax withheld from the sale and paid to the state of California? And so you need to work with your client to say, if you did pay that state income tax already, as a tax preparer, you need to obtain the escrow papers and see how much tax was paid, and then put in as a credit on the taxpayer's tax return, right, on the California tax return, hey, this person already paid 3 1/3% from this property sale as withholdings. And so that is going to cover part of the tax, and that's very important that you put that withholdings number, how much tax the person has already paid, in your tax software. You have to, there's different areas and different tax softwares where this information can be entered, but just on a general note, you need to realize, okay, you had a property sale in California, I'd like to look at your escrow papers, I'd like to make sure that if you did pay to the Franchise Tax Board is the name that it'll be listed under, that where the payment goes. If you paid that tax to the state of California, we need to pick that up on your California tax return, and you need to be credited as having paid that tax. So extremely important. When you hear the words, I sold property, a piece of real estate in California last year, you need to think to yourself, well, I need to be aware, did this person already pay some state tax to California? If you don't pick up those tax amounts, it's going to definitely screw up the entire return, because remember, in California, the property sales are often a large number. So let's say that the person sold a $600,000 property and they had 3 1/3% withheld from that amount and paid to California. That's almost $20,000 right there, right? That you need to pick up and say, oh, this person already paid $20,000 in California income tax out of their property sale, and make sure that they get credit for that on their current year tax return. Extremely important then. So realize whenever you're dealing with the situation of a California piece of real estate being sold in the tax year for which you're preparing the tax return, it's very important to realize how the system works in terms of this property sale withholding requirement. So that requirement is placed on the escrow company or whoever handles the real estate transaction, and that's the enforcement mechanism for the Franchise Tax Board. So Franchise Tax Board requires that if you have an escrow company in California, you have to abide by this law, that unless an exception is met, you have to pay us that tax, that 3 1/3%, out of escrow. And so before the seller receives the proceeds of the sale, the escrow company has to remit or send that payment to the state of California. Now there are a few major exceptions where the escrow company does not have to send that payment. And the first exception would be if the property being sold is being sold for less than $100,000. So let's say it's a $40,000 vacant lot that's being sold. The escrow company would not be required by law to pay that 3 1/3% to the Franchise Tax Board. The second main exception, and the one you'll most often encounter, is if the property being sold is the personal residence of the taxpayer. So remember, there's a certain personal residence exclusion where you can sell your personal residence and you may not have to pay tax on part of the gain. And so therefore, since you're not going to have tax liability, the escrow company, if it's the taxpayer's personal residence that's being sold, may not be required to withhold that 3 1/3% and send it to the state of California out of that escrow account. The third exception would be if the property is part of a tax-free exchange. So one piece of investment real estate is being traded for another piece of investment real estate according to that Section 1031 like-kind exchange concept. There's not going to be any income tax due on that transaction if it's done correctly. So therefore, the escrow company won't have to withhold the tax. And also the last exception would be is that if you don't have a gain on the sale of the property. So if you sell property at a loss, the escrow company would not be required to withhold that tax and send it to the state. We've seen this a lot in recent years where California real estate has declined in value quite a bit. So you have many taxpayers who may be selling the property, but they're really not making any profit on the sale. And if you don't have any profit on the sale, if you bought a house for $200,000, now you're selling it for $100,000, you don't really have any income tax due on that sale. So there's a special form in that case, which is called Form 593, which can be filled out, and that form will be given to the escrow company, and it will tell the escrow company, this taxpayer does not have any tax due on this sale because they have a loss or they have no gain, and so therefore there's not going to be any tax, so don't send in that 3 1/3% tax withholdings. And what will happen sometimes is the escrow company will tell the taxpayer, consult with your tax advisor, have them fill out this Form 593 so that we don't have to withhold the California income tax and send it to the Franchise Tax Board. That may be something that you encounter then is a request, hey, can you help me fill out this Form 593? First couple times you fill out that form, it may be a little bit tricky. You know, it can be a little bit tricky in certain situations, but overall, if you realize what's the purpose of filling out this form for your client, and the purpose of it is to give permission to that escrow company to not pay the 3 1/3 income tax withholdings to California. So once you fill out that Form 593 with your client and you see, hey, there's no profit on this property, then it gives the escrow company the option to not pay the withholdings tax. So those are some of the more advanced topics that you need to be aware of with regard to property sales, but the overall and very important kind of fundamental concept is whenever you hear that a piece of California real estate was sold and it's not a personal residence, it's over $100,000 in value, it's not part of a tax-free exchange, and there was a gain on the sale, when one of those exceptions is not met, you need to realize, oh, I need to see the escrow papers because I need to credit that taxpayer for that 3 1/3% that was taken by the escrow company and paid to the state of California. So whenever you're dealing with a California piece of real estate that's been sold, those are some sort of tricks of the trade and general information that will help you handle that situation like an experienced tax pro.